housing market is seeing some record-breaking numbers take place right now as we continue to see home sales reach rock bottom levels. We're continuing to see homeowners very reluctant to list their home right now on the market. Mortgage demand has completely gone out the window and buyers are still nowhere to be found. It's a crazy dynamic of what we're seeing take place in the housing market right now. And so in today's video, I'm not only going to give you the most up-to-date information, but also going to share with you some markets that are already experiencing yearly declines at this point. But before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. And with that said, let's jump into it. The housing market is off to a heck of a start as we've just reached a new low with median sales price going down to $350,000 according to the weekly numbers from Redfin. We're continuing to see prices decline ever since around June of 2022 last year when we reached peak levels roughly around $390,000, and so up until this point we're already seeing that the median sales price has already declined over 10% from peak levels. Well, right now it's starting to get very interesting because we're seeing a lot of metropolitan areas starting to see yearly declines take place, and the big difference is when you're talking about declines from peak levels, you're taking the highest price point it was throughout the year, and we're talking about the decline we've seen from that point. That was in June, and of course before June we saw this meteoric rise in prices continuing to take place as we had seen in the years prior to that. So naturally it takes some time to see those prices decline to the point where it starts to become a year-over-year decline, especially considering how much prices had gone up. This is unfortunately where you might come across certain real estate professionals to where you address your concern about a declining market as prices continue to decline, and they'll throw back at you the year-over-year stats that, well, the market overall is actually still up year-over-year. Well, that's not a very honest way to look at it. They may try to throw seasonality, but this is much bigger than seasonality, what we're seeing at this point. And so now we're at the point where 19 of the top 50 most populated metro areas are seeing yearly declines, and that's only going to get worse as we get closer to June. But with that said, I want to point out some of the markets that are seeing some of the biggest year-over-year declines so far. And at the top of the list, hands down above every other metropolitan area, is San Francisco, already seeing prices fall 10.4% year-over-year, and of course from peak levels it's even bigger than that. Continuing on in the list, we got more declines in California markets, down 6% in Sacramento, 5.6% in San Jose, 5.4% in Los Angeles. This is a lot of what I've been talking about, that not only will the pandemic boom towns be seeing some serious declines eventually, but especially the expensive markets in California particularly. And continuing on in the list, we start to eventually reach these pandemic boom towns, but in general we got Detroit down 4.6%, historically not a great appreciating market. We got Oakland down 4.4%, Seattle down 4.2%. We've been talking a lot about Seattle. And then as you go further on in the list, you start to hit some of these pandemic boom towns. 2.9% decline in Austin, Texas. You got Phoenix down 2.4%. And like I said, this is just the beginning stages at this point, and it's only going to continue to get worse, especially the pandemic boom towns. These were cities that we saw such massive rises in prices take place, where it was a little bit more modest with some of these California cities like San Francisco, like Sacramento, and so that's why we're seeing bigger yearly declines in those places at this point. Now we know that the biggest reason why we've been seeing prices decline this much has really been driven by affordability just going out the door altogether. People cannot afford houses at this point, and this is driven because mortgage rates last year were roughly between 3 to 4% around this time. Now they've gone up drastically to the point where they're at about 6.5%, and that change in mortgage rate has added hundreds of dollars a month even for median priced homes. Now what caused these mortgage rates to go up in the first place was the Federal Reserve has been getting very aggressive with its monetary policy in order to fight inflation. Well, as of the latest reports, mortgage rates right now are currently down a little bit, down to 6.14%. 4%, making it a little bit more affordable than it's been for the past several weeks. And even though the Federal Reserve has been showing that they're going to be a little bit more hawkish throughout 2023, because it's already for the most part baked into the mortgage rates we see today, that's why I don't believe we're going to see mortgage rates continue to go up throughout 2023. This, as a result, will naturally limit the downside potential compared to what we were looking at back around October, November time, when we thought that we may be looking at 8%, 9%, some even said 10% mortgage rates. This is a different outlook now, with mortgage rates probably staying around the 6% range. Now, that's not to say that we don't have further price declines on the way. I definitely believe we do, especially because starting with mortgage rates right now, we are still catching up to the affordability problems we experience with even today's mortgage rates. Now, that aside, we of course have problems with iBuyers that have overbought a bunch of houses at higher prices than they're actually worth today. They're continuing to have to offload these discounted properties. Builders also trying to slash prices and incentives in order to offload those. All those affect future comparables for existing homes that are currently on the market. And of course, the economic recession that is likely to come as a result of the Federal Reserve continuing to stay extra aggressive with its monetary policy. But as far as buyer demand goes, we just got the latest numbers come back for mortgage purchase applications, which is a great indicator of buying demand. It hasn't been updated in the last couple of weeks, and what we saw is mortgage applications, the purchase applications, are down over 12.2% in the last 2 weeks. Now, that's a pretty significant decline for just a couple weeks time, and it's a seasonally adjusted number. So some people that might point to, well, things slow down in the wintertime, well, that's already baked into the number itself. It's also down 42% year over year. Now, the main reason that we're seeing this drop in buyer demand take place is there are so much concerns about the future economic recession taking place. Of course, people don't want to buy a home and then immediately lose equity as home prices continue to plummet. The outlook of the economy does not look good, especially for 2023. And so that makes a lot of potential buyers very nervous, and they'd rather wait for a better time to buy. Now, a very interesting number, especially with mortgages altogether, they just hit the lowest level of mortgage applications since 1996, almost 30 years ago at this point, and that's just a lack of demand. Of course, with the purchase applications we see that, but especially in the refinance market, nobody wants to refinance their home right now. It makes zero sense to refinance your home at this point. So this is pretty bad news for any mortgage banker or mortgage broker out there that's looking for business, but in general, this real estate slowdown is affecting many people throughout the real estate industry. I talked about this last week in my video about how existing home sales are down to the lowest levels we've seen since November of 2010. And not only that, but pending sales was the real shocker, coming back at the second worst report we've ever seen since they've been tracking that data since 2001. Now, this is a big deal because, of course, pending sales is an indicator of homes that are currently under contract that are going to close in the future. So they're essentially looking into the future of what existing home sales will look like down the road. And when you start to factor in things like an economic recession on top of that taking place, well, that just makes an even gloomier outlook for the housing market as far as activity is concerned. Now, it's not just the buyers that are holding up this end of the deal with sales continuing to plummet, but homeowners, they really just don't want to list their home. And we're seeing evidence of that with Redfin's latest report showing that new listings coming on the market is at the lowest level that's ever been recorded. We're seeing that new listings are currently down over 22.4% year over year. And a big reason for that is many homeowners, they currently have a very low interest rate locked in. In fact, it was reported that over 62% of homeowners with a mortgage have under a 4%, so that's a 2 or a 3% mortgage rate. And then over 85% of homeowners have a mortgage that's under 5%, so that's a 2, 3, or 4%. You're not going to want to trade that off for a 6.5% rate. So when you combine that with the fact that we're seeing some of the lowest buying demand we've seen since at least 2015, it puts us in a situation to where homes are starting to sit on the market longer and longer. The median days on market has now gone up to about 42 days on market, which is up from the 17 days on market it was back last year around March or April time, and it really just continues to get worse and worse every week that we get more updated reports on that. Now, historically, 42 days isn't an extremely high number to be be concerned with at this point, but it's a number that continues to go up nonetheless and will likely to continue going up throughout 2023. Housing activity in general, we can expect throughout the rest of the year is going to continue to get worse, especially as the Fed released their Fed minutes the other week and really showed their cards to continue to be very hawkish, continue raising rates, and they made it very, very clear that there will be no rate cuts throughout 2023. So for those people who are looking for a pivot to take place in 2023, it's probably not going to happen at this rate. And so as things progress with economic conditions continuing to get worse, I think we can see that continuing to have an effect on buyer demand, and as a result, housing activity will continue to slow down, and we can continue to expect that house prices will continue to see more downward pressure taking place. So with that said, this is the latest of what's going on in today's housing market. If you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any thoughts or questions, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.